All right, so get ready because we're diving into some serious investing wisdom today. We've got excerpts from The Intelligent Investor by Benjamin Graham.
The OG of value investing.
That's the one. And we've got some really insightful commentary by Jason Zweig to help us unpack it all.
And you know what's amazing? Even though Graham wrote this book back in 1949, his ideas are like shockingly relevant today.
It's crazy, right? Like, talk about timeless wisdom. So when Graham talks about being an intelligent investor, what exactly does he mean? Because I think a lot of people think it's about, like, you know, day trading and being a Wall Street wizard or something.
It's actually the opposite. He's
Yeah.
not talking about chasing the latest hot stocks or trying to time the market perfectly. It's more like being a financial detective, really.
Well, I like that, a financial detective.
Yeah, he's all about finding those hidden gems, the companies that are worth way more than their stock price suggests and buying them with a nice comfy margin of safety.
Margin of safety. Now that sounds intriguing. Like a financial seatbelt. Can you break that down a little bit more?
Think of it this way. No matter how good you are at analyzing a company or a market, you will never be able to predict the future perfectly, right?
Right. Always surprises.
Exactly. So a margin of safety, it's like a buffer zone. It's that difference between what you think a company is really worth, its intrinsic value, and the price you're actually willing to pay for it.
Okay, so it protects you from those, what do they call them, black swan events?
Precisely. It helps you to weather those unexpected storms that inevitably pop up in the market.
Okay, so speaking of storms, Graham actually compares the stock market to a manic depressive patient. It's a pretty vivid image, right? I mean, he uses some pretty wild examples of companies that just skyrocketed to crazy heights and then crashed and burned spectacularly.
He does, doesn't he? And that analogy is so spot on because it really captures how the market tends to overreact, both on the upside and the downside.
Oh yeah, big time. I mean, think about the dot-com bubble, right?
Right.
Companies that had like zero earnings, sometimes even no revenue, were suddenly being valued in the billions.
Yeah.
It was total speculation, pure hype.
It was. It was like everyone was just so afraid of missing out that they lost all sense of reason.
And speaking of losing all sense of reason, there's that crazy story in the book about AAA enterprises.
Oh, yeah. I remember that one.
They lost pretty much all their capital, but somehow their stock was still valued at, get this, $25 million.
It's mind-boggling, isn't it? It shows how detached from reality the market can become.
Seriously. It's like everyone was wearing those rose-colored glasses, or maybe they were just looking at a completely different set of numbers.
Graham actually talks about this phenomenon. He says that in the short run, the market is like a voting machine. It's all about popularity, emotions, and speculation.
Ah, so it's like a high school popularity contest, basically.
Pretty much. But in the long run, he says the market acts more like a weighing machine. It's about a company's actual worth, its earnings, its assets, the fundamentals.
So eventually, reality sets in, right? The weighing machine takes over.
Eventually, yes. But the problem is that in the short term, that voting machine can create a lot of volatility and a lot of opportunities for people to make, well, not so intelligent investment decisions.
Right. So how do we avoid getting caught up in all that hype and fear? How do we learn to think like the weighing machine, even when everyone else is going crazy with the voting machine?
Well, one of the best ways is to do what Graham calls comparing companies. He loved to put companies side by side to really expose the market's biases. It's a great way to force yourself to think critically.
Oh yeah, that makes sense. And you've put together some pretty fascinating pairings for us to look at today. I mean, these aren't your typical textbook examples, are they?
Definitely not. I wanted to have a little fun with it.
Okay, so we've got Cisco, the internet darling,
Yeah.
versus Cisco, the food supplier.
Yeah. Same name, completely different businesses.
Talk about confusing. And then there's Yahoo, back when it was the hottest thing on the internet, versus Yum, the restaurant company, KFC, Taco Bell, all that.
Right. It's like comparing a rocket ship to a minivan. But it really makes you think, doesn't it? Is a good company always a good investment at any price?
Good point. I'm guessing the answer is no.
Exactly. And then, to top it off, we have the head-scratching case of Palm and 3Com.
Oh, yeah, that one's a doozy, where the subsidiary was worth more than the parent company.
Market madness at its finest. And these examples really illustrate how emotions and psychology can drive prices far beyond what's rational.
Right, so it's like we need to remember that we're not just buying pieces of paper, we're buying ownership in real businesses.
Right, exactly. And we need to make sure those businesses are actually worth what we're paying for them. That's where the detective work comes in.
It makes you wonder, who's really in control here? Is it the market? Or is it the intelligent investor who can see through all the noise and make those rational decisions?
That's the million-dollar question. And Graham definitely believed that investors shouldn't just be passive bystanders. He wanted them to think and act like owners, to really understand the businesses they were investing in.
He even went so far as to suggest that independent directors should write reports directly to shareholders. That's pretty radical, isn't it?
It is. He felt very strongly that too many managers were focused on building empires and enriching themselves instead of actually creating value for the real owners of the business, the shareholders.
And we saw some pretty egregious examples of that in our research, too. I mean, think about the Enron scandal. Those executives were clearly more interested in lining their own pockets than in building a sustainable business.
Absolutely. And that's why it's so crucial for investors to pay attention to corporate governance, to really understand how a company is being run, who's making the decisions, and whether their interests are aligned with yours as a shareholder.
Right, because at the end of the day, we're not just buying stocks, we're becoming partners in these businesses. And like any good partner, we need to make sure we're on the same page.
Exactly. And that's where Graham's concept of the intelligent investor really comes into play. It's about taking ownership, doing your research, and demanding accountability from the companies you invest in.
And that, my friends, is a great place to wrap up part 1 of our deep dive. Stay tuned because in part 2, we'll be exploring even more of Graham's insights, including how to analyze a company's financial statements, identify those competitive advantages that really matter, and of course, how to find those hidden gems that the market has overlooked.
It's going to be a wild ride.
Okay, so you're saying I need to think like I own the business and I'm a detective to be a good investor.
Yep, that's the Graham approach. Remember how we talked about the market being like super emotional, like a manic depressive patient?
Oh, yeah, that was a good one.
Well, a big part of being an intelligent investor is like understanding those crazy mood swings, those market cycles, the ups and downs.
Because if you let yourself get swept up in all that emotion, you're probably going to make some, well, less than intelligent decisions.
Totally. Like when the market is booming, it's easy to get caught up in the excitement and pay way too much for stocks.
Yeah, FOMO is real.
It is. And then when the market crashes, everyone panics and sells everything at a loss, but the intelligent investor, well, they stay focused on the long game.
They're like, this too shall pass.
Exactly. They know those cycles are going to happen. It's just part of the game, and they use them to their advantage.
So how do we do that? How do we avoid those emotional roller coasters and stick to our plan, even when everyone around us is freaking out?
Well, one way is to remember that a lot of the time the market is driven by fear and greed, not logic.
So it's like our primal instincts are working against us.
Pretty much. When everyone's piling into a hot stock or a trendy sector, it's often a sign that things are getting overheated.
So like a warning sign.
Mm.
And then when everyone is running for the exits, selling off in a panic, that's usually when there's some good deals to be found.
Often, yes. Those moments of fear can create amazing opportunities for investors who have done their homework and have cash on hand.
So it's almost like you need to be, what's the word, contrarian, like go against the crowd.
Yeah. In a way, yeah. But it's not just about being contrary to be different, It's about thinking for yourself, doing your own research, and understanding a company's true worth.
Right, not just blindly following the herd.
Exactly. It's about being brave enough to buy when others are fearful and maybe sell when everyone else is feeling greedy.
Yeah, easier said than done though, right? I mean, it takes a lot of discipline to sit on the sidelines when you see everyone else making money.
It does. But remember, investing is not a sprint, it's a marathon. Slow and steady wins the race. The goal is to build wealth over time, not get rich quick, and that takes patience and discipline.
Okay, so how about actually picking stocks? How do we actually find those hidden gems, those companies that the market is undervaluing?
That's where the detective work really kicks in. Graham had a specific set of criteria that he used to evaluate companies. He looked for companies with a solid track record of earnings, a healthy balance sheet.
So strong fundamentals, basically.
Yep. And he also looked for companies that had a history of paying dividends.
Ah, so they're sharing the profits with their owners.
Right. He saw that as a sign of financial strength and a commitment to shareholders.
So it's not just about, chasing the latest hot stock tip. It's about actually digging into the financials and understanding the business.
That's it. And he also wanted to see that a company was trading at a discount to its intrinsic value.
Okay, wait. We've been throwing around this term intrinsic value a lot, but what does that actually mean?
It's basically a fancy way of saying what a company is truly worth. Like, if you were going to buy the whole business, not just a few shares of stock, what would you pay for it?
So it's like we're appraising the entire business, not just looking at the sticker price on the stock market.
That's a great way to put it. And the intelligent investor, well, they're always looking for bargains. They want to buy a dollar's worth of value for 50 cents.
So it's like bargain hunting, but for businesses.
Kind of, yeah. But it's not just about finding a cheap stock. It's about finding a great company that's maybe temporarily out of favor with the market, for whatever reason.
So we do our research, we understand the business, we look at the financials, and then we compare the stock price to that intrinsic value.
That's the process. It's about combining the quantitative stuff, the numbers, with the qualitative stuff, the company story, its competitive landscape.
So it's not just about crunching numbers, it's also about understanding the bigger picture.
Exactly.
So let's say we've done all this detective work, we found a few companies that we think are undervalued. What then? How do we build a portfolio? How do we decide how much to invest in each stock?
Well, this is where diversification comes in. Graham was a big believer in not putting all your eggs in one basket.
Smart man.
He was. He believed in spreading your investments across different industries, different types of assets, stocks, bonds, maybe even real estate.
Makes sense. Don't want to bet everything on one horse.
Right. Diversification is like an insurance policy for your portfolio. It helps to reduce the overall risk and smooth out those ups and downs.
So instead of trying to pick that one winning stock, we're building a portfolio that will perform well over time, even if some individual stocks don't do so hot.
That's the idea. And Graham had some specific recommendations for building a diversified portfolio. He liked a mix of stocks and bonds, with the exact mix depending on your risk tolerance and your investment goals.
So like a younger investor with more time to recover from losses might have a higher percentage of stocks, and someone closer to retirement might want to be a bit more conservative.
Yeah, that's a good general rule of thumb.
Okay, I'm starting to get the big picture here. Thinking like a business owner, being a detective, staying disciplined through those market cycles, and diversifying our portfolio.
You got it. You're well on your way to becoming an intelligent investor.
But there's one more thing I've been wondering about. Even if you do all your research, you find great companies, you buy at a discount, isn't there always a chance that, something unexpected could happen?
You're absolutely right. There are always going to be things outside of our control. A pandemic, a war, a new technology that disrupts everything.
Yeah, those black swan events we talked about earlier.
Exactly. Even the most intelligent investor can't predict the future perfectly, and that's why risk management is so, so important.
Okay, so how do we manage risk? How do we protect ourselves from those unexpected punches?
Well, diversification is a great place to start, as we talked about earlier.
Spread the risk.
But there are other strategies too, like really understanding the different types of risks that are out there and having a plan for what to do if things go wrong.
So what are the big, scary risks I should be worried about?
Well, let's break it down. First, you've got business risk. This is the risk that a company's earnings might disappoint. Maybe they face new competition or consumer tastes change, or they just have bad management.
Right, so even a good company can run into trouble.
Absolutely. And then there's financial risk. This is the risk that a company might take on too much debt or mismanage its finances in some way.
Like those companies we talked about earlier, the ones hoarding cash or doing those weird stock buybacks.
Yeah, those can be red flags for sure.
So I got to make sure a company's financially healthy before I invest, not just look at its stock price.
That's right. Now, the third type of risk is market risk. And this one is a bit trickier to manage. It's the risk that the whole market might decline, even if the companies in your portfolio are doing fine individually.
So like a rising tide lifts all boats, but a falling tide can sink them all.
Kinda, yeah. Market risk is tough because you can feel like you're doing everything right, but you're still losing money.
Super frustrating.
It is, and it's something you can't completely eliminate, but you can reduce its impact.
How so?
Well, through diversification, for one, and also by having a long-term perspective and, you guessed it, demanding that margin of safety.
Wait, back to the margin of safety again. I thought that was just about buying stocks at a discount.
It's more than that. It's also about having a buffer built into your portfolio so you can withstand those unexpected market drops.
So the margin of safety is like a financial airbag.
Exactly. It's there to protect you in a crash.
Okay, I like that. So diversification, a healthy balance sheet, and a margin of safety. Those are my risk management tools.
Those are some excellent tools. But remember, it's not just about picking the right stocks or having the perfect strategy. It's also about knowing yourself, your risk tolerance, your financial goals.
Right, because everyone's situation is different.
Exactly. What works for one person might be a disaster for another. There's no one-size-fits-all approach.
This makes me think about all those common investing mistakes people make. Like chasing hot stocks or trying to time the market. I bet Graham had a lot to say about that.
Oh, he did. He warned against all those classic traps, those emotional decisions. Remember, the market is like a manic, depressive patient. Don't play his game.
Don't try to outsmart the market, just stick to your plan.
That's the key. Intelligent investing is not about getting rich quick. It's about building wealth steadily over time, making informed decisions, and managing risk like a pro.
Well, this has been a really fascinating discussion. We've gone way beyond just summarizing the intelligent investor. We've really dug deep into these principles and how they apply today.
It's amazing how relevant Graham's ideas still are, even in today's crazy market.
So what's the one big takeaway you want our listeners to remember from all of this?
Easy. Become an intelligent investor. Don't let yourself get swayed by all the noise and hype and fear. Do your homework, demand that margin of safety, and build a portfolio that aligns with your goals.
Awesome advice. So next time you're thinking about investing, remember what we've talked about today.
Ask yourself, is this an intelligent investment?
And if you're ever feeling lost or unsure, remember Graham's book is always there for you, a timeless guide to navigating the market and building a strong financial future.
Couldn't have said it better myself.
Thanks for joining us on this deep dive. Until next time, happy investing. Okay, so we've covered a lot of ground, haven't we? Market cycles, picking stocks, diversifying, that whole financial detective thing.
We have, but, there's one more piece of the intelligent investor puzzle we need to really dig into, and that's risk management.
Yeah, that's the part that always makes me a little nervous.
Right. Because, you see, even if you follow all of Graham's principles, even if you do all your research and find great companies, there's always a chance that something completely unexpected could happen.
Like, what if I do everything right and I still end up losing money? I mean, think about what happened with the pandemic. Nobody saw that coming.
You're right. We don't have a crystal ball, unfortunately. And that's exactly why risk management is so important. It's about understanding the different types of risks that are out there and, having a plan for how to deal with them. It's about protecting your downside.
Okay, so what are the big scary risks I need to be thinking about?
Well, let's break it down. First, you have what's called business risk. This is the risk that a company's earnings might not be as good as you expect.
Oh, okay, so like maybe they face new competition or people's tastes change or maybe they just have bad management.
Exactly. So even a good company can run into trouble, for all sorts of reasons.
Right, so I can't just assume that a company that's doing well today will always do well.
That's right. Now, the next type of risk is financial risk. This is the risk that a company might have too much debt.
Ah, okay, so they've borrowed too much money and they can't pay it back.
That's one possibility. Or maybe they just mismanage their finances in some way. Remember those companies we talked about earlier, the ones hoarding cash or doing those strange stock buybacks?
Yeah, those were a little fishy.
Right. Those can sometimes be warning signs that something's not quite right with the way a company is managing its money.
Okay, so I need to pay attention to that stuff, not just focus on the stock price.
Exactly. Now, the third type of risk is called market risk, and this one can be a little trickier to grasp. It's the risk that the entire stock market might decline, even if the individual companies in your portfolio are doing well.
Oh, I hate that. It feels so unfair, like you're doing everything right, but you're still losing money.
It's true. Market risk is tough to stomach, and it's something you can never eliminate entirely. But you can certainly do things to reduce its impact.
Like what?
Well, like we talked about earlier, diversification is a great tool for that. And, having a long-term perspective also helps. Remember, the market goes up and down, but over the long term, it tends to trend upwards.
Right, so it's about riding out those waves, those ups and downs.
Exactly. And then, of course, there's our good friend, the margin of safety.
Wait, the margin of safety? I thought that was just about buying stocks at a discount.
It's more than that. It's also about having a cushion built into your portfolio, so that you can weather those unexpected market storms.
So it's like if I buy a stock for less than it's really worth, even if the market drops, I'm less likely to lose money because I had that built-in discount.
Precisely. It's all about recognizing that the future is uncertain and giving yourself some room for error.
I'm liking this margin of safety more and more. So, to recap, diversification, a healthy balance sheet, and a margin of safety, those are my shields against risk.
Those are some powerful shields. But, there's more to risk management than just those things. It's also about understanding your own personal risk tolerance, How much volatility can you handle? What are your financial goals?
Right, because everybody's different and everybody has different needs.
Exactly. Investing isn't one size fits all. What works for one person might not work for another. You have to figure out what's right for you.
This is making me think about all those common investing mistakes that people make, like chasing hot stocks or trying to time the market. I bet Graham had some strong opinions about that.
Oh, he did. He warned against all those emotional traps, those classic mistakes that investors make over and over again. Remember, the market is like that manic depressive patient. Don't get sucked into his game.
Don't try to outsmart the market, basically.
Right. Just focus on what you can control. Doing your research, making informed decisions, sticking to your plan.
Okay, so it's about being disciplined and patient and not letting our emotions get the best of us.
Exactly. Intelligent investing is about building wealth steadily over time, not about getting rich quick.
Well, this has been a fantastic deep dive. I feel like I've learned so much about Graham's approach to investing.
Me too. It's amazing how his ideas are still so relevant today, even though he wrote them decades ago.
So if you could leave our listeners with just one big takeaway, what would it be?
I would say, become an intelligent investor. Don't be swayed by all the noise and hype and fear that's out there. Do your research, demand that margin of safety, and build a portfolio that aligns with your goals and your risk tolerance.
Great advice. So next time you're thinking about making an investment, remember what we've talked about today.
Ask yourself, is this an intelligent investment?
And if you're ever feeling lost or unsure, remember Graham's book, The Intelligent Investor. It's a timeless guide to navigating the complexities of the financial markets.
It really is, and I think it's something that every investor should read, no matter their experience level.
Absolutely. Well, thanks for joining us on this deep dive. Until next time, happy investing.